The silver market is a ticking time bomb, and the countdown just skipped a massive beat. While paper traders on Wall Street are desperately trying to smash the price down at the current resistance level, a silent bank run is happening right under their noses in the physical vaults. We are currently witnessing a historical divergence that will break the financial system's grip on precious metals. The paper price faces artificial ceilings, but the physical vaults are bleeding dry at a rate we have never seen before. You are being lied to about the true supply of silver, and the breaking point is no longer years away. It is happening right now, this month. Welcome back to The Value Stalker. I am your host, and my absolute focus is tracking the real data behind the silver market to find the value that others are missing. Today, we are breaking down a massive anomaly that the mainstream financial media is completely ignoring. In this video, we are going to expose the critical physical redemption crisis hitting the iShares Silver Trust, known as the SLV ETF, right now. We will discuss why borrowing costs for this ETF have just exploded to over 11%, signaling a massive short squeeze in the making. Furthermore, we are going to analyze the latest warning from macroeconomist Peter Schiff regarding how relentless industrial demand is rapidly drying up global inventories. This is the exact fundamental catalyst that will shatter the current resistance level and send prices into triple digits. If you want to know what the smart money is doing while retail investors panic over a $2 drop in the paper market, you are in the exact right place. Let us start by contextualizing the battlefield. Right now, silver is fighting a brutal war at the $80 psychological and technical resistance level. We saw the explosive volatility earlier this year, where speculative momentum drove prices past $100 before the inevitable paper market margin hikes and manipulated sell-offs brought us back down to the high 70s and low 80s. The bullion banks and the financial media are trying to paint this as a permanent top. They want you to believe that the rally is over, and that mean reversion will drag silver back down to $50. But the data tells a completely different, much more explosive story. We have to look at what is happening inside the SLV ETF, the largest paper-silver vehicle in the world. As of this week, the SLV ETF is facing unprecedented structural stress. This is not just a minor liquidity hiccup, it is a full-blown physical redemption crisis. Over the past 2 weeks, the number of SLV shares available to borrow plummeted by an astonishing 99.9%. We went from 10 million shares available to short down to a microscopic 10,000 shares. At the same time, the borrowing fee to short this ETF has skyrocketed to 11.5%. Why does this matter, and why should you care? Because this severe supply crunch is colliding with the expiration of tens of thousands of in-the-money call options. The people holding these contracts do not want cash settlements. They are demanding the physical metal. They are redeeming their SLV shares for actual physical silver, and they are draining the ETF's liquidity. The short sellers are now trapped in a precarious position. They are scrambling to source shares for their delivery obligations, but the shares simply do not exist. This is the definition of a short squeeze, not driven by retail meme stock traders, but driven by institutional demand for physical delivery. To understand the gravity of this, we need to look at the COMEX vault data, which perfectly mirrors the SLV crisis. Former investment bankers are calling this the 100 pizza problem. Right now, the COMEX claims to hold roughly 400 million ounces of silver in its vaults, but that number is an illusion. You have to separate eligible silver from registered silver. Eligible silver belongs to private owners. It is just sitting in the vault for safekeeping and cannot be used to settle futures contracts unless the owner explicitly decides to sell it. Registered silver is the only metal actually available for delivery to satisfy paper contracts. Right now, that registered inventory is hovering near 103 million ounces, down over 70% since the start of the decade. So, you have a massive open interest of paper contracts representing hundreds of millions of ounces of silver, but only a fraction of that is actually available to be delivered. It is exactly like having 100 pizzas and 400 starving people showing up for dinner. When the music stops, someone is going home empty-handed. And when industrial users realize they might go empty-handed, panic buying sets in. This brings us directly to the undeniable fundamental driver of this physical drain: industrial demand. Silver is not just a monetary metal. It is the most conductive element on Earth. and it is the irreplaceable backbone of the modern technological revolution. Let us listen to what macroeconomist Peter Schiff recently had to say about this exact dynamic and how it threatens the entire supply chain.
I'm glad that you mentioned the precious metals there as well as part of that strategy, because it seems like there's two different sides to this, right? Within the gold area specifically, most people targeting gold as a store of value, right, and an asset here that could replace something like the dollar, but then you have some of these precious metals, platinum, copper, et cetera. And we talked briefly before this, and you mentioned the inflation thematic, but also the demand for them, right? As you have AI data centers built, electric vehicle mandates. Do you pay attention to much of that when it comes to the rare earth and metal side of things?
Pay attention to what?
Basically just the increase in demand that we're going to see for.
Oh, yeah. I mean, certainly with respect, look, you look at what's happening with silver demand for batteries, AI generating demand. So, yeah, I mean, demand is a big part of price. And a lot of the demand, of course, is byproduct of inflation. But then you've got the supply constraints. There's a limit to how much silver can be mined. So metals are a lot different, let's say like agriculture. If soybean prices go way up, farmers can stop farming corn or wheat and plant more soybeans, right? And try to increase the supply of soybeans. But if there's a big increase in the demand for silver, they just can't start pumping out more silver. I mean, if they would already be mining it if they had it. So it's going to take a long time and much higher prices for the market to respond to higher prices with additional supply.
Schiff is absolutely correct here, and his point exposes the fatal flaw in the Bullion Bank's short thesis. When the price of silver drops in the paper market, it does not discourage demand. In fact, it does the exact opposite. It encourages massive, rapid accumulation by the entities that actually need the physical metal to survive. Let us break down this industrial demand because it is entirely price inelastic. When we say price inelastic, it means that a manufacturer is not going to stop buying silver just because the price went from $30 to $80. Consider the solar photovoltaic industry. Solar panel manufacturing is the fastest growing industrial application for silver consumption today. Each high-efficiency solar panel requires approximately 10 to 20 grams of silver. The global push for renewable energy is adding massive solar capacity every single year. This expansion translates into approximately 150 million ounces of annual silver consumption just for solar applications alone. That is roughly 15% of total global mine supply, completely devoured by one single sector. Then you add the electric vehicle market. Every single electric vehicle requires roughly 2 to 3 times more silver than a traditional internal combustion engine vehicle. It is used in the battery management systems, the wiring, the autonomous driving sensors, and the charging infrastructure. Add to that the explosive growth of artificial intelligence data centers, 5G networks, and advanced military applications. All of these sectors require physical silver. Here is the critical distinction between investment demand and industrial demand. When an investor buys a 1,000-ounce silver bar, that bar goes into a vault. It is stored, and it could theoretically be sold back into the market if the price gets high enough. It represents secondary supply. But when an industrial manufacturer buys silver, they melt it down, spread it across thousands of microscopic circuit boards or solar cells, and effectively destroy it. That silver is consumed. It goes to a landfill at the end of its life cycle because recycling it from consumer electronics is largely uneconomical. This creates a permanent, structural, and compounding supply deficit. The Silver Institute has already confirmed that we are running massive annual deficits of hundreds of millions of ounces. The world is consuming significantly more silver than we are pulling out of the ground. Primary silver miners like Kerr Mining and Fresnillo cannot simply flip a switch and double their production. It takes 5 to 10 years to discover a deposit, permit it, build the infrastructure, and start extracting ore. Furthermore, most silver is actually mined as a byproduct of copper, zinc, or lead mining. Therefore, even if the silver price doubles, a copper miner is not going to drastically increase their operations just to get a few extra ounces of byproduct silver. The supply side is fundamentally rigid. So, how does the current resistance level break? It breaks when the paper manipulation mechanisms fail. Over the past few weeks, we saw the CME Group initiate margin hikes on silver futures contracts. For those who do not know, a margin hike is when the exchange forces traders to put up more cash collateral to hold their positions. Historically, this is used as a kill switch by the exchanges to force leveraged long traders to sell, thereby artificially crashing the price and bailing out the institutional short sellers. But here's why this time is different. The margin hikes are failing to break the trend. The paper price dipped, but the physical premiums in markets like Shanghai skyrocketed. The physical buyers, the sovereign nations, the industrial giants, and the institutional whales are ignoring the paper price action and simply taking delivery of the metal. The divergence between the paper spot price and the actual cost to acquire physical silver in bulk is widening. When the SLV ETF loses its ability to borrow shares, and when the COMEX registered inventories fall below the critical threshold required to maintain confidence in the futures market, the paper resistance levels will simply evaporate. The institutions shorting silver will be forced into a massive short covering rally, buying back contracts at any price to avoid defaulting on delivery. This is the exact setup that precedes a violently explosive breakout. The consolidation we are seeing right now in the high 70s and low 80s is not a top. It is a launchpad being built on the foundation of a structural physical deficit. To summarize the reality of the market right now, the resistance you see on the charts is an illusion created by a paper derivatives market that is rapidly running out of ammunition. The borrowing costs for the SLV ETF have soared to 11.5% because there are no physical shares left to borrow. The COMEX registered vaults are draining towards zero, operating like a bank facing a massive run on its deposits. And as Peter Schiff accurately pointed out, relentless, price-inelastic industrial demand from solar, electric vehicles, and AI is systematically consuming whatever inventory is left. Silver is not just breaking a technical resistance line, it is breaking the entire pricing mechanism that has suppressed it for decades. The floor has been fundamentally raised. Now, I want to hear from you. Look at the data, the vault drains, and the industrial consumption. What is your realistic price prediction for silver by the end of 2026? Are we going to cleanly break $100? Or do you think the bullion banks have one last trick up their sleeves? Drop your exact price target in the comments section below. I read every single one. If you value this deep dive objective analysis of the silver market, make sure you hit the like button and subscribe to the Value Stalker. We do not do fluff, and we do not follow the mainstream herd. We follow the data, we track the physical metal, and we stalk the value. Thank you for watching, and I will see you in the next video.